this week, and today we're going to talk about a few patterns I try to avoid as much as possible, and you should too. If you like these videos, definitely give me a like on this video and also subscribe to the channels. Now, you guys know I'm not a big YouTuber. I'm not trying to collect fans here, but I just want to be educational, informative, and help you guys out as traders. So here we go. All right, so the first one that I look at, that I'm looking at here, I'm looking at the ticker JOBS Jobs. And the first pattern we're going to try to avoid as much as possible. While certainly could be good swing trades here and there, but we're talking about jobs with a a double top. All right, here if you look at the chart, I'm looking at a daily chart, and here you have a top on the left and a top on the right. So generally what happens in the market when you see a pattern like this is that there may be some catalysts, okay, once it finds this support. Once the market has decided that the price does not justify the fundamentals of the company for whatever reason, generally here you'll see the catalyst run up, and we see a big ugly candle here, bearish engulfing candle, and it immediately dumps down, and it tries to break that resistance one more time, but it had trouble to meet this top here. So I call this a double top here. All right, and we are obviously moving in a general down direction. So try to avoid this as a swing play. Certainly if you are a day trader, there's some opportunities if you look at the minute charts and hour charts, but on a daily candle it just looks pretty bad for even a swing trade. All right, the next one that we're going to look at is we're going to look at ABT. All right. And by the way, guys, I am using a TradingView. All right, so definitely sign up for TradingView. It's 25 bucks a month, easily affordable. All right, and here let's look at another pattern, what we call the head and shoulders. You've probably heard of this many times. All right, here we saw that Abbott had a high of 115.14, and that is the absolute top that the market will tolerate for this particular stock. And here we have what we call left shoulder, okay, or left, it's not LH, sorry, it's left shoulder and right shoulder. And once we find that support line here, unfortunately it breaks the support and is trying to do another possible cup and handle. Maybe it'll climb back up here range, but without any news from the company, nothing with breakthroughs. You'll see this continuing to trend downwards. All right, and another one that you should also avoid is what we call a rising wedge pattern. I'm going to look at Tesla, and you can almost consider this to be a bear flag as well. We'll look at the minute charts on Tesla today and see what's going on after a significant downtrend such as this today, the red bars here. So I'm going to draw a quick line here. All right, you'll see this happening quite often. If you are an experienced day trader, of course, this is a great pattern setup in terms of going in for a quick day trade. But if you see this kind of start happening, you have to know that this is a rising wedge pattern. After a significant downtrend, there should be some type of bounce up, okay? Once it bounces up, all right, what it'll generally do after breaking higher highs and higher lows, you'll see this dump off right out of the channel. If you are a day trader, definitely doable. However, it's potentially risky, and it causes people to be very bullish and risk more money into this trade and hoping for a bounce. And we see that Tesla so far today, after a high of 680 something here, has moved downwards significantly down to the 668, but it's still up for the day. All right, so there you have it, guys. Just remember the three patterns I've talked about so far: double top, head and shoulders, and the rising wedge. All right, and I will talk to you guys next week.